This video looks at an intergroup inventory transaction that has taken place during the previous period. In this example, on 1st of July 20XO, Michael raised 520 million of share capital to acquire 100% Samuel's business ownership, keeping the remaining balance as cash. The investor firm is called Michael Parent and the invested firm is called Michael Subsidiary. At the date of acquisition, Samuel's business had share capital of 200 million and retained earnings of 220 million. Shareholders' equity therefore is 490 million, represented by 480 million of land and 10 million of inventory. There were no liabilities, therefore net assets equals 490 million. During the 30th June 20X1 year, that's the first year following transactions took place, Michael Subsidiaries sold 10 million of inventory to Michael Parent for 20 million. Michael Parent first recorded the inventory purchase as cost of sales in the income statement and transferred it to inventory on the balance sheet at the end of the year. You have received the financial statements for Michael Parent and Michael Subsidiary on 1st July 20XO, that's the date of acquisition, and 30th June 20X1, that's end of the first year. Income tax rate is 30%. Required. At the end of 30th June 20X1 year, that's in the first year, 100% of inventory was unsold. Prepare consolidation journal entries and consolidated financial statements for 1st July 20X2. That's at the beginning of the second year. At the date of acquisition, Michael Parent raised 520 million of share capital, invested 500 million in the subsidiary, and had 20 million of remaining cash. And Michael's subsidiary, Samuel's business previously, had 200 million of share capital and 290 million of retained earnings. And as assets, it had 480 million of land and 10 million of inventory. On 30th June 20X1, end of the first year, the inventory was unsold. So at that time, 30th June 20X1 year, for the Michael Parent, there was inventory that was unsold. There was a transaction of inventory that Michael bought, 20 million worth of inventory recorded as cost of sales, and Michael Subsidiary recorded that as revenue. But real cost is 10 million. But at the end of the year, because inventory was unsold, it was transferred from cost of sales to inventory on the balance sheet. Michael used the cash that was remaining here to buy the inventory. That 20 million was used to purchase inventory. And Michael's subsidiary sold inventory and received cash of 20 million. Because of the sale, Michael's subsidiary has income tax payable and income tax expense. On 30th June 20X1, Markel had to do the following consolidation journal entries. There were four. The first one was to eliminate the investment against the fair value of Markel's subsidiary. So credited investment 500 million, and at the date of acquisition there was 200 million share capital, 290 million retained earnings, and the balance was the investment in goodwill, and that's goodwill on consolidation. There was a trading transaction from Markel's subsidiary to Markel parent, and that is eliminated by debiting revenue and crediting cost of sales. In this sale trading transaction, there was unrealized gain of 10 million. That unrealized gain has to be eliminated from inventory that's been held, and then from the increasing the cost of sales by 10 million. Because of the unrealized gain, because the tax base increased to 20 million because of the sale, but still the carrying value was 10 million, there was a deductible difference of 10 million, and that gave rise to deferred tax asset by applying the tax rate. So fourth consolidation journal entry was to debit deferred tax asset and credit income tax expense. Because the inventory was unsold on 1st of July 20x2, the beginning of the second year, the entries that needs to be done are the first entry as at the date of acquisition, that's the elimination entry, elimination of investment entry. But the second entry is unnecessary because it's the trading transaction that has taken place in the previous period, that's in 20x1, but it's not in 20x2. So that is not necessary. So the consolidation entry number 2 is not necessary. But number 3, consolidation journal entry, was to eliminate gain on sale of inventory. That gain on sale of inventory, the inventory is now transferred at the beginning of the year from balance sheet onto cost of sales. So therefore, the unrealized gain included in inventory now is in cost of sales. Therefore, we credit cost of sales at the beginning of the second year. And the cost of sales that was there, where the gain, unrealized gain, was previously decreased, unrealized gain was previously decreased, and that cost of sales is in retained earnings, and therefore it's in the previous period's retained earnings. We need to decrease the retained earnings for that unrealized gain from retained previous period retained earnings. We debit 10 million there. At the beginning of 20x2 year, at the x1 year, the carrying value was 10 million and the tax base was 20 million and the deductible difference was 10 million. And applying the tax rate, deferred tax rate, asset was 3 million. But when in 20x2 year, the carrying value became 0 and the tax base became 0, because in 20x2 year, inventory is going to get sold because it's now cost of sales. So the deductible difference becomes 0. Therefore, there is no deferred tax asset instead there is income tax expense that needs to be debited, and for the previous period income tax expense that has to be credited into the retained earnings previous period. We can now enter the consolidation journal entries in the worksheet under debit and credit columns. So our first entry would be elimination of investment, credit investment in subsidiary for 100 million, debit share capital 200 million, and debit retained earnings 290 million. The remaining amount is 10 million goodwill on acquisition. Our second journal entry is not relevant because it's a trading transaction, but the third journal entry is to eliminate the gain on sale of inventory. We debit retained earnings and credit cost of sales. Our third journal entry is to debit income tax expense and credit retained earnings previous period. So we can see once we have prepared our consolidated financial statements, what we have is the cost of sales of 10 million that's remaining there. Because it's still not sold, it is still sitting there as profit before tax, but it's a loss at the moment with the income tax expense, which is negative. If it is not sold, which is not the case because it's inventory, it will get sold. Otherwise, income tax loss here then can be transferred as a deferred tax asset because it's going to be a tax loss. But that won't be the case because the inventory will get sold during 30th June 20X2 year. Right now, it's at the beginning of the year. Goodwill on consolidation still remains here. And the land still remains here, 480 million. And the cash is 20 million. And from previous period, there was income tax payable that was there that we need to eliminate because of the sale of inventory. There was income tax payable, 10 million of gain, 20 million less, cost of sales 10 million, and the gain on sale was 10 million, and on that income tax expense was 3 million, and the tax payable in the previous year was 3 million, and that has to be paid. So therefore there will be cash outflow, and the cash balance now becomes 17 million. And income tax payable here is here for Michael parent because it's still not sold. The income tax payable is shown as -6 because this will then become a tax loss because the payable is negative. But that's not going to happen because the inventory will get sold. Therefore, this would be the group or the economic entity financial statement position. Now, if we assume that the inventory sold during this year or the 1st of July 20XO, 1st of July 20X2 year, inventory was sold at the cost price, which is 20 million was sold. And then if it is sold at 20 million, then Michael parent would not be making any profit out of it. But there won't be any income tax payable, there won't be any income tax expense, and Michael would be receiving cash because of the sale of 20 million, would be receiving cash. And here the inventory is the inventory that was transferred from the from the balance sheet to cost of sales right at the beginning of the year for sale. And when we look at the group financial statement, what we see is that inventory was sold outside the group for 20 million and its cost of sales was 10 million. So therefore, the group made a profit of 3 million and the income tax expense is 3 million. And the profit for the group, therefore, is 7 million. And because the profit is 7 million and the share capital of the group is 520 million, and therefore the shareholders' equity in the group becomes 527 million. On the asset side, there's goodwill on consolidation 10 million, land 480 million, and then the cash, because the inventory is now sold, and there's 20 million of inventory that was sold and received cash. And then on the Michael subsidiary, there was 20 million of cash, but then there was income tax payable that was paid out. And because of that, there's 17 million. And that together became 37 million of cash. Therefore, the net asset position is 527 million. Shareholders' equity is 527 million. The only difference when the inventory was not sold and inventory was sold is that the cash flow or the net asset position changed from 513 million and it became 527 million. The change of 14 million is because with revenue, the profit was 7 million. Without revenue, loss was 7 million. Actually, is the profit situation that we should consider, which is 7 million. But otherwise, the consolidation journal entries remain the same. That brings us to the end of the video, and thanks for watching.